Hello, everyone, and welcome back to Accounting Basics. Have you ever looked at a company and wondered, are they actually making money or do they just look good on the surface? Well, there's one key document that spills all the secrets. It tells the complete story of how a business is performing, from the first dollar in sales all the way down to the final profit. And today, we're going to break it down together. In the next few minutes, we're tackling the income statement, also known as the profit and loss or the P&L statement. By the time we're done, you'll be able to look at one of these and see the real story behind a company's financial health. So what exactly is an income statement? Think of it as a financial movie. While other reports might give you a single snapshot in time, the income statement shows you what happened over the whole period, like a month, a quarter, or an entire year. It's the story of a company's performance, not just a single photo. Its main job is to answer one simple question: is this business profitable? It figures this out by starting with all the money the company brought in, then subtracting everything it spent. Whatever's left at the end is the bottom line. To make this really click, let's build an income statement for a simple fictional business we'll call Clara's Coffee Corner. We're going to follow her journey for a month to see if her new coffee shop is actually making a profit. Every income statement starts right at the top with revenue. It's often called the top line, and it's the total amount of money a company earned from selling its stuff. For Clara's Coffee Corner, let's say in 1 month she sold $10,000 worth of coffee, pastries, and merch. That $10,000 is her revenue. It's the starting point of our whole story. Okay, so she made $10,000, but what did it cost her to directly make the things she sold? That's where the cost of goods sold, or COGS, come in. These are the costs tied directly to creating your products. For Clara, that's her coffee beans, milk, sugar, flour, and even the paper cups she serves the drinks in. Let's say all those ingredients and supplies cost her $3,000 for the month. Now, if you take the revenue and subtract the cost of goods sold, you get your first big checkpoint: gross profit. This tells you how much money is left from just selling your products before any other expenses. It's a key indicator of how profitable your core business is. So for Clara, we take her $10,000 in revenue and subtract that $3,000 in COGS. That leaves her with a gross profit of $7,000. Not bad. But of course, coffee beans and milk aren't the only bills a business has to pay. You also have operating expenses. These are all the costs that you have to pay just to keep the lights on, things that aren't tied to one specific coffee. This includes rent for the shop, your employee's salary, electricity, and maybe some marketing to get the word out. Let's say Clara's rent is $2,000. She paid her barista $2,500, and her utilities and marketing added up to another $500. Her total operating expenses are $5,000. So what happens when we take our gross profit and subtract those operating expenses? We get our operating income. This number is a huge deal. It shows you the profit a company made from just its main business. It tells you if the fundamental business model is actually working. For Clara, we take her $7,000 gross profit, subtract the $5,000 in operating expenses, and she's left with an operating income of $2,000. Okay, we're almost there. After calculating operating income, a company accounts for any other financial odds and ends, like interest it paid on a loan, and finally, you can't forget about taxes. The government needs its share. To keep it simple, we'll assume that Clara doesn't have any loans, but based on her income, she needs to set aside about $400 for taxes. After we've subtracted the direct costs, the operating expenses, and the taxes, we finally arrive at the net income. This is the famous bottom line. It's the number everyone wants to see because it's the actual profit left over at the very end of the day. So, we take Clara's $2,000 in operating income and subtract that $400 in taxes. Clara's Coffee Corner has a net income of $1,600 for the month. That's her real take-home profit. Okay, so let's run that back. We started at the top with revenue, subtracted the direct costs to get gross profit, subtracted the day-to-day operating costs to find the operating income, and finally, took out the taxes to land on the bottom line, the net income. The income statement tells a clear story, showing you exactly where every dollar goes and what's truly left in the end. If this breakdown helped you, do me a favor and hit that like button and subscribe for more simple guides to finance and accounting. Now that you know the story of a company's profit, you need to know about the snapshot of its financial health. That's called the balance sheet, and you can bet that we'll be covering that one in the next video. See you next time.